Hello, everyone, and welcome to today's webinar. This is part 2 of our town hall format on the impact of COVID-19 on valuations. We're very fortunate to have our panel back with us today, and I will introduce them in a moment. My name is Andy DeZamba, and I'm the executive editor here at BVR. What I would like to do now is introduce our panel. Stacy Collins is a managing director at Financial Research Associates, and her experience includes marital dissolution cases, corporate litigation, estate planning, valuations, and transactions. Michelle Gallagher is a strategic partner with Adam Valuation, where in addition to serving clients with valuations for tax and other matters, she leads the firm's family law practice. Harold Martin is the partner in charge of valuation and forensic services for Kiter and an adjunct professor for the College of William & Mary Graduate School of Business. He is an inductee in the AICPA BV Hall of Fame, an instructor for the AICPA National BV School, co-author of Financial Valuation, and an editorial board member of Business Valuation Update. Gary Trugman is president of Trugman Valuation and is the author of one of the preeminent textbooks in the profession entitled Understanding Business Valuation, a practical guide to valuing small to medium-sized businesses, which is now in its 5th edition. With that, I'd like to have our panel make some opening remarks, and I would like to ask them to address this question, and that is, since our last town hall, which was about 4 weeks ago, how have your thoughts evolved about the impact of the virus on valuations? We'll start with Stacy Collins. Stacy?
Thanks, Andy. Hi, everybody. Thoughts I have on this. One is just how varied I think different companies' response and effect to this crisis will be. Obviously, there's going to be variability significantly in some respects based on the industry that you're in, based on perhaps the part of the country that you're in, how quickly your area reopens, whether you are able to utilize federal funds, which we'll talk about a little bit later. So I think there's definitely not a one-size-fits-all approach to dealing with this for an individual company. And the story, I think, is really going to evolve over time. I think we're going to know a lot more a month from now than we do now. I think the other thing, candidly, that I think I underestimated a little bit a month ago is just how much the federal loan programs have evolved over time. There are things that I thought were really kind of set in stone that really aren't and have continued to evolve. And that's something that I know all of us are cognizant of, but that's going to have an effect on different companies in different respects.
Thanks, Stacy. Michelle, how about you?
Well, it's been a busy 30 days, for sure. Definitely the federal funding and the PPP loan program, I'm going to spend a fair amount of time talking about in some sections, but the problem is the rules keep changing, not only in that, but everything. The unknowns continue to mount. And, you know, I asked the panelists before we started this for the valuations that we have right now with current dates, what are we all doing? And I said to the group, and I'm not afraid to tell this whole panel, I'm really just trying to punt and delay and try to figure out, you know, how far down the road can we hold on and see what comes out of this? Because, you know, many states, many areas are definitely starting to slowly reopen, and seeing the impact of that, I think, is very important. Interestingly, if anybody's from Georgia, I was just on a call today with a client from Atlanta, and, you know, Georgia's opened up, right? And the restaurants that have opened up are now closing because nobody's actually coming out to them. So it's really going to be interesting as each of these states and even counties within states start reopening to see what that reaction is, because we're all looking at trying to forecast these cash flow streams. We'll talk about that. but boy, we're already starting to see maybe what we thought would happen isn't going to happen. So again, trying to do the best with the information that we have, and certainly the ever-changing areas we're trying to bank on are very challenging. So I look forward to hearing what my other panelists are up to, and as well as what the questions are from the group. So please send them in.
Great, thanks, Michelle. Interesting point. Yeah, you can reopen, but will you get your business back? Harold Martin, how about you?
Yeah, I guess I would reiterate what I said in the first session, which is, the situation we're dealing with is really not dissimilar from that we dealt with when we had the financial crisis in late 2008 into 2009. Analysts were already calling for a recessionary period in 2020. And, in my opinion, what has happened is the pandemic simply accelerated entry into that recession and perhaps caused it to be deeper, and it may last longer than it otherwise would have. In terms of the issues that's presented for us to consider, and what we've been dealing with recently, is we're having to assess each valuation on a case-by-case basis. You have to consider the country in which the business is located that you're valuing. You have, as Stacy mentioned, you have to consider the industry because different industries have been impacted differently. Some industries have actually benefited from the effect of the pandemic because there's more demand for their product, for example. Others, and probably the majority, have been adversely impacted. And then the final thing that we're wrestling with is, depending on the purpose of the valuation, that has a lot of implications. For example, in a divorce case, if you're representing the property spouse, you're probably advocating for a valuation date that occurred after the pandemic's effects. If you're advocating for the non-property spouse, you're probably advocating for an earlier date of separation that preceded the pandemic's effect. And what's equitable in a court of law. So again, we're all wrestling and grappling with those different kinds of issues. And again, that's just going to be on a case-by-case basis.
Thanks, Harold. Gary Trugman. Oh, Gary, we lost your audio.
Let's see. Is that any better?
There we go.
Okay. There we go. Hi, everyone. Let's
Gary,
try it again.
I liked it better the first
You liked it better when you couldn't hear me. I know. Well, I was going to say I agree with all my colleagues except for Harold. But the truth of the matter is, I find this period of time to be very different than 2008. 2008, we had a real economic recession. We were in a fairly strong economy up to this pandemic. And, with all recessions, you watch the cycle where the recession lasts a couple of quarters, and then you see big P multiples in the public market come out of it because earnings are low and the forecast is rosy. But I think for those of us that are valuing closely held businesses, we're in uncharted waters here. Because the first question that we almost have to ask is, will the business even return to business as usual? Not so much when, but if. In the past, we weren't as worried about the if, because closely held businesses didn't really imitate the public market as much. And, we'd see things going on in the public market, and you'd see the multiples in the closely held world stay somewhat consistent over a long period of time. Now you have to scratch your head and you say, when these businesses reopen, if they reopen, is anybody going to come to them? The point about Atlanta right now happens to be a very real point. We're dealing with this in southern Florida right now. The state of Florida is partially open except for 3 of the counties in South Florida, one of which I'm in. And the question is, if you opened up the restaurants tomorrow, I don't know about everybody else, but I'm not in a rush to go to sit down in a restaurant right now. There are a lot of things. I mean, I don't see myself rushing to go to a mall anytime soon. You know, I've become a very big fan of Amazon lately. You know, they deliver. I empty the box out in the garage. I then wash my hands. You know, and it's a different world. And I think as we do valuation work, we need to think about this changing world that we're in. You know, I think those people that do a lot of bankruptcy work, I think you're going to become very busy because there's going to be a lot of bankruptcy going on. The question is going to be, can anybody afford your services? And that, unfortunately, is going to be the problem. Andy, all yours.
Yeah. Interesting. Thanks. Getting a lot of questions coming in. We've had some questions come in before, and some are on there. Maybe the first one, if we could, one of the questions that came in is there any, has any consensus been reached on know or knowable, either as of December 31 or any dates between January through now? Gary, we'll continue with you. What about that?
Well, I think, you know, certainly if you're doing a valuation as of December 31st, 2019, the question that we all have to ask, especially if it's a fair market value valuation, a typical valuation, we base it what's known or knowable. The question is, do we know, or did we know at that time that we were going to hit this kind of an issue? And I think you have to look at all the different businesses. I think all my panelists have pretty much agreed. You have to look at the facts and circumstances. If you've got a supplier that is in Wuhan, China, you may have seen what was going on a lot earlier than if you're just valuing a local restaurant that wasn't shut down because the pandemic hadn't reached the United States yet. As we do things currently, I think we have to constantly be looking at when was it known or knowable. We have to talk to our clients. The management interview becomes more important than ever. And I think we have to try to figure out, and it's not just for the business, it's their customers, it's their suppliers, it's the whole chain that you have to look at to figure out what and when might this have been known or knowable. So I don't think they're also, I think the consensus is, I don't think it's a one size fits all.
Anyone else on that?
Yeah, Andy, I'll chime in. Following up on Gary's points, I do agree that you have to look at, again, things on a facts and circumstances basis. But I think generally with respect to December 31st, 2019, at least with respect to the U.S. markets, I think most people would agree that the effect of the pandemic was not known or knowable as of that point in time. And so consequently, you would not consider it with respect to your evaluation. Depending on when your report was issued, for example, if your report occurred later after the adverse impacts of the pandemic, you certainly would want to make a subsequent event disclosure, in my opinion. In terms of when the pandemic's effect should be reflected, if you look to the U.S. stock market as a barometer, I think it was the period February 20 to 24 that we really started to see the markets reflect the effect of the pandemic. And so, again, pick your date, but I would say somewhere in that time range, you would probably consider the event to have been known or knowable, and I would reflect that in my valuation for a valuation prepared subsequent to that time.
Andy, you know, one thing to consider here, and you know, I'll respectfully disagree with Harold about one point in particular. You know, the fact is we have a valuation date, and yes, we have a report date. Our professional standards do not tell us in valuation that anything that occurs between the valuation date and the report date is supposed to be disclosed. Otherwise, you're subject to a lot more disclosure than just the pandemic. And the real question becomes, and I think we all have to be practical, why are you doing the valuation? if you're in a situation where you need to make somebody aware of something, that something happened. I mean, if you have to tell somebody at this stage of your life that there was a pandemic, that person probably shouldn't be doing whatever it is they're doing, that you're reporting to. But the fact of the matter is, I'm very reluctant to start disclosing things after the valuation date because it wasn't known or knowable.
But the thing is, this is not a flood. This is not a fire. This is not a loss of a customer. I mean, this is a worldwide event. And I've had clients ask me whether this would be factored into cases where I have a valuation date 2 years ago. So, we in our profession know the concept of known or knowable, but it's not clear to me that the outside world necessarily appreciates that issue to the extent that we do. So I do see the benefit in this particular instance, unlike most cases, of just being clear that the reader knows that you're doing this valuation at whatever 6/30/19, and no, it doesn't include the effects of this. It's an unusual circumstance we're in, but that it may call for an unusual response.
Well, that could be an extraordinary, limiting condition in the business. I don't know that it has something to do with a report date, though. Then the question becomes, how many more extraordinary conditions do you put into a report? If a large customer is lost subsequent to the valuation date, do you disclose that? Wouldn't that have a devastating effect on a business? So, I don't know that I would jump on the bandwagon of trying to put all these disclosures in after the valuation date. We may have to educate people on what's known or knowable and what does it mean.
Before we go in, I think we're morphing into the whole subsequent event topic, which I think we will definitely be talking about in the toolkit. But before we do, I just wanted to comment on this known or knowable. So I had put in the answers to the April 7th document there that our firm had sort of pinpointed when the market started reacting to the pandemic was somewhere around February 20 to 24. So initially, that was my initial thought and our initial thought in terms of the time. But interestingly, I think to Gary's point, people send me weird charts and stuff all the time. So I've been kind of accumulating them and threw some of them into the slides. And I thought, well, I can't remember if it was Harold or Gary who said it. Oh, there we go. Harold and Gary are Harry. I just came up with I'll just refer to both of you that way. Whoever said, when did it actually start impacting our businesses? So maybe it impacted the markets, the public markets in February 20 to 24. But when did it really start impacting Main Street America, our small businesses? And so I put together, I just threw a bunch of slides that I've been getting. I'm going to try and pull these up and just show you what some of these timetables. Let's see, I've got to get back to the right. Are the slides up there? I'm sorry to ask this,
Yes.
but
Yep.
Okay.
Yep, they are.
Okay, so and I love charts and they're great. I'm a nerd, so this kind of stuff excites me. But this was one that somebody shared, and this is Google mobility, and you can see the dates. Remember I was saying, February 20 to 24 is when the public market, you can see it's still way up in the positive, but really the actual decline from a retail and recreation decline didn't start happening until it looks like around March, 10th, 15th, somewhere in there. So that to me is kind of an interesting point of fact. Additionally, this economic index sort of says the same thing, and this measures, all economic activity, and all this is out there publicly available. So, feel free. These materials I think are out on our webinar, but if you wanted to dig into even more details, but you can see on this one again, things are, humping along pretty well until about, March 15th, when Main Street America was starting to feel the true impact. And then this, of course, is another timeline from, the World Health Organization on the COVID cases and when they really started taking off. And, mid-March is really a consistent time period when, to me, you can really start the reaction of how consumers reacted to all of this, not necessarily the public market. So I think that brings in a whole different set of dates that maybe we have to be mindful of, and specifically our specific companies. Sitting down, we've got to drill into every single company very specifically and when this known or knowable was there. When we were talking about recovery periods, so, when was known or knowable on the front end, when are we going to know the known or knowable on the back end? We were talking about the historical. So these are slides from Duff & Phelps webinar that was on April 16th, and you can go to their website and it's a free download to get all of their slides. But I just thought some interesting pickups on that. These are the historical crashes and how long the recoveries were. So we've been talking a lot about 2008, right? And 2008 crash in the bottom box there took 5.47 years, but it was a very long decline. And this decline, as we know in COVID, is very quick. I mean, the public market decline was, according to this chart, less than a month. And they also provided, I thought this was some interesting data in the Duff & Phelps presentation. Depending on how quickly and how much the decline was, how long it took to recover. So some of this data is out there for us as we're forecasting recovery. Nobody knows when we're truly going to come back. I've heard 18 months, I've heard 5 years, I've heard, each industry is going to be very, very different. But my point in sharing all of this is there's a lot of data out there for you to look at and try to help hone, your specific facts and circumstances into some of these areas. So I have some more charts later, but those were just the ones I wanted to share in terms of the known or knowable topic.
The interesting thing, Michelle, the one interesting thing that Michelle pointed out was, a lot of it's going to really depend on industry. I saw an article this morning when I was reading a local paper, and obviously we live in South Florida, which is the cruise capital of the world. And there was an interesting article that Norwegian Cruise Line just changed their public filing, and it looks like they may have added a going concern clause in their audit, in which case, a bankruptcy may be happening very soon. And let's face it, if you're in a hospitality industry, if you're in a vacation type industry, it's not looking too good. I mean, these airlines are talking about after September 30, laying off gobs of people because they're looking at some financing till then, but they don't know if nobody's booking flights. So when you look at all of this, you really have to look at it by industry. And remember, all this Duff & Phelps data, and it's all good data. The issue is a lot of it is publicly traded companies with value and closely held businesses. Are they going to behave the same way?
Also, we had, speaking of industry, yes, we also had a comment from the audience that geography will also play an important part in that. I mean, a restaurant or retail business, the audience
absolutely
in New York City will be a lot different in terms of a rebound than a same business in Nebraska. So that was a comment from our audience.
Hey, Andy,
Yeah, Harold, yeah.
not to belabor the point, but I do have a rebuttal point to make with respect to Mr. Trugman's assessment of subsequent event disclosures. If you read AICPA SSVS standard, it pretty much leaves it to the discretion of the appraiser to determine whether or not to make such a disclosure if in the event, in the appraiser's opinion, that would be of interest to a user of that report. And I would argue that if you've done a valuation, let's say dated 12/31/19, and you're issuing a report today, that being advised by the appraiser that the effects of the pandemic are not reflected in the valuation results would be something that would be of interest to the user. I mean, that's really what it
I don't disagree with you, Harold. I don't disagree at all with you on that point, Harold.
It's not like you're telling the audience something they don't know. What you're doing is you're clarifying the results. I almost don't even consider this a subsequent events disclosure, because it's something that really every person is going to know it happened. It's not new information. It's just putting the prior valuation date in perspective in a way. So that's why I agree with you, Harold. I think that explaining that it's not included can sometimes be helpful to the reader.
I'm more likely to put that, and I know we're going to talk about methods later on, but I'm more likely to put that into my revenue forecast in the discussion about the basis for my revenue forecast, that it doesn't include the impacts. I might put it there as opposed to burying it in a limiting condition somewhere, just to be clear to the reader. I think we all want to be as clear as possible to the reader, but I don't think it's an automatic just because there's a report date and a valuation date. And that was really the only thing I was disagreeing with you on, Harold. Otherwise, we do agree on a lot of this stuff.
Okay,
Did I just hear you say that you agree with Harold? I just want to be clear.
Yeah, I do agree with him. Absolutely. And I'll say it a number of times.
we have this being recorded, so we do have it memorialized.
I would like a copy of that excerpt.
You were Harold. You were referencing the AICPA material. That's kind of a segue into kind of the next question that we've received. Has any particularly helpful guidance come out over the last month that you found particularly helpful? Stacy, maybe you could talk to that.
Well, on the issue of subsequent events, the audience may know that there's a toolkit from the AICPA on the issue of subsequent events. And I don't know that there's anything new in it, but it does provide some clarity, I suppose, on the concept of known or knowable, giving some examples. There's an example of a disclosure, talks about a hypothetical where there's a contract that's signed after a particular valuation date, but a lot of the information, it was expected and knowable that contract was going to be signed prior to the valuation date. And so I think if you're trying to sort out the facts and where you are at a particular date, it might put you in the right frame of mind. So it's absolutely worthwhile reading. The other thing, touching on the discussion we had a couple of minutes ago about when all this happened, that I think is a useful resource, is the timeline that Jim Hitchner prepared, that I think, correct me if I'm wrong, Andy, is in the materials on the BVR website at this point?
Well, yes, it's on our BVR website. We have a special COVID-19 resource page, and there's a link to it on that page. It's a free document.
Great. And just to be clear, what I'm talking about, if you're not familiar, is a very detailed timeline from 12/31/19 forward, noting all these different events that we're talking about. So it talks about the changes in the market returns and when each market index went down, as Michelle was touching on earlier, and the effects of that, and all these different events at the federal level, state, et cetera. So if you have a valuation date during this very volatile time that we're dealing with, it might help put you in the right frame of mind. And I've looked at that, and I think it's just useful to be able to pinpoint, if you're trying to discern what you knew at one point versus another, what to look at. So yeah, I've looked at both of those things.
Back to the AICPA toolkit, it does give 3 examples of some language that folks can use. So if you haven't come up with your own language yet, if it is something you're going to put in your reports, letters, limiting conditions, wherever you are putting it, there are some good examples from more detail down to in a little bit more of a summary format. So if you are looking for some examples, they are there. Is it fair to ask my fellow panelists, and I'll go first, I don't mind sharing, what are you doing with this subsequent event disclosure? And I can tell you, we have written our own language, and we are putting it, and this is just on a December 19 valuation. So we made a decision to add language to our transmittal or cover letter. So it's right out and center that we have not incorporated it. We cite the SSVS section and the known knowable discussion, but we decided to put it right up front, so there's just no question that we addressed it.
I like that idea. I mean, I've had cases where I didn't put it in the valuation conclusion because I had already communicated to people based on questions they asked me of whether it would be factored in, yes or no or whatever. And so I think the reader, it would be helpful to know those kind of things. And I think putting it somewhere in the report, I think we're all talking about different places to put it, but putting that somewhere is, I think, useful information.
We include a specific section in our report in cite, again, as was indicated, the AICPA SSVS standard. We explain that it has not been reflected in the valuation based on the fact it was not known as of the valuation date. And we also cite the timeline as support for why we did not reflect it.
Right, we do that
basically
too.
I'm doing the same thing, and yeah, I'm putting actually wording relating to the standard, particularly the AICPA standard, SSVS, and I'm actually cutting and pasting a small section out of one of the comments that's in my book, talking about explaining what is known or knowable and what it means, so that the reader has more of an understanding of why we did not or did include something. So it's really just in educating the reader about what's known or knowable.
We had a question just come in from the audience asking for thoughts on the timelines that you're referring to. Should they be referenced in your reports? The specific timeline.
We are referencing Hitchner's timeline, for example, and the reason that we're doing that is I do a lot of litigation work, and I want to provide support for why I made the decision and took the position that I did, that it should not be considered as of the valuation date, assuming, again, we're talking about a 12/31/19 date.
I think I would have it in my work papers, but I don't know that I would necessarily put it in the report itself. And I also do a lot of litigation work.
I don't remember which dates we have in our disclosure, but we definitely are identifying the key dates that have been identified in the various timelines, including Hitchner's. So we are doing that as well, whether it's a litigation report or not. We kind of have a standard set of language we're using.
I sent it out on a case in the last week. It's not in the report itself, but I sent that PDF out when the question came up, just emailing with the attorneys in a case where I'm in the middle.
Someone asked about a link to the AICPA toolkit. I believe believe the AICPA has a COVID-19 resource page, I believe, and I think it's on there. So I think it's pretty easy to find. Does anyone know that specifically?
I think you can Google it.
Yeah,
Yeah.
that's right. That's exactly how I found it. I Googled AICPA subsequent events toolkit and it came right up.
Yeah, the actual title is AICPA VS Section 100 Subsequent Event Toolkit. So that should come right up.
Mhm.
Okay. Questions from the audience coming in about the CARES Act and what's any kind of update on that and insights on how to reflect that in the valuations. Michelle, we know you're very much involved in that.
Very involved.
Your thoughts? Thanks.
Sure, I will kick it off and let my fellow panelists pipe in. I'm sure everybody is very well aware that the PPP program ran out of money quickly, and it took a little bit of while to get it back online again for round 2, but more funds have come to light and are still being distributed. As far as I know, those have not run out yet. But what's been interesting and hot in the news lately, and I'll talk about the valuation aspect, but I just kind of want to do a quick overview, is all the folks who got the PPP loan and then decided, or when one of the FAQs came out that said, hey, you really had access to funds somewhere else, you need to give that money back. Some very large companies, for example, have been getting a lot of press. They're also talking about publicizing the list of folks who got the PPP loan, so you can go in and see. So there's been some interesting stories in the news and a lot of people rethinking whether or not they should have gone for those PPP loans or not. And so I think there's a lot going on in that area. I want to pull up just to that comment, the actual, let's see, is it on the slides? I did want to just let people know Treasury in the PPP program through the SBA are regularly up on the Treasury's website issuing FAQs. And so there's, I think, 45 or 46 of them right now. So if you have questions about certain things in the PPP loan, but this question 31 is what's creating all this hoopla, if you will, on returning the money. And a lot of folks have gone back and looked at the certification statement that they signed saying, yes, we need these monies, and rethinking, well, did we really need them? Currently, we haven't heard what the penalties are if you did take PPP money and you shouldn't have. So we are still waiting for some guidance in that regard. But if there's anybody on the webinar here who is having second thoughts about taking the PPP money for their firms, their businesses, whatever, initially they gave you until May 7th, which of course is tomorrow, to make that decision. But just so you know, this FAQ number 43 just came out last night that is extending that decision to May 14th. So this is getting a lot of press right now, and a lot of people internally in their businesses are really trying to figure out if this is something they should send back or not. Now, in terms of valuation aspect, I guess the other big news item on the PPP is banks, and I think there's going to be some litigation down the road on this, so keep your litigation hats on and open for this. But certain banks allegedly got the paperwork done quickly and efficiently and loans approved for their preferred clients and customers. And the little guys, if you will, or those not preferred or on the preferred list, got put on the bottom of the pile and either didn't get the funds the first time around or are still waiting for the funds in the second time around. It's a real challenge. So I think we're going to see some issues with that down the road. As of right now, like I said, I don't think they've run out of money. I would highly encourage people who, if you are with a bigger bank or your clients are with bigger banks and having challenges, to reach out to a community bank. The community banks, I am on the board of one, but they really have done an outstanding job. And in this latest round of PPP funds, community banks were actually given a carve out for, I think it's $1 billion specifically for community bank customers. So if you're having trouble yourselves or you have businesses, please consider that. But that's the general overview of PPP. Now, valuation, how does it impact valuation and what are we doing about it is still evolving, of course. The real focus right now in this PPP, I mean, we thought initially the calculation on how much the loan was going to be was a challenge. This whole aspect of what the loan forgiveness is going to be has become very complicated, very, very complicated. And as most of you know, and if you don't know, the IRS just issued a notice last week saying that the expenses associated with the loan forgiveness are non-deductible. Now, that decision by the IRS is facing some serious challenge from the congressional side. AICPA has issued a statement and making recommendations that the intent of the CARES Act was for this to truly be what we would call a double dip, where you don't have to, the funds received are not going to be taxable, but at the same token, the deductions associated would be deductible. That's what Congress and the CARES Act is believed to be the intent. So when the IRS came out with this non-deductibility notice last week, really caused a lot of stir, if you will. And so that is being challenged, but as we sit here today, it's really a wash from a taxability standpoint. The funds coming in that are forgiven will be not taxable, but of course the expense is not deductible. So from a cash flow perspective, and the tax impact of that right now in your modeling would be a wash. But again, the rules change every day, so stay tuned on that one.
It's interesting because, we're talking about what's reasonably foreseeable, and none of us really know right now, but I know we were talking before we went on air, and the congressional letter that went to the IRS yesterday or to Treasury Department says exactly what you said. It was the clear intent of Congress with the CARE Act to make the expenses deductible. So if the IRS doesn't back down, will Congress be able to pass legislation to enforce their intent? I mean, I don't know. If it happens, it's not going to happen tomorrow, but it'll be interesting to see how this evolves. And it does have the potential to affect our valuations as we parse out the cash flow from this particular year. It really makes it a little bit murky.
I still think that 2020 is going to end up being considered to be an aberration. And we may end up throwing the year out from all of our analysis only because think about the non-essential business that's been closed. Right. No revenue coming in. They get a loan so that they can keep their employees going. But is that really representative of future income for the business? Would you really want to value the business on that? I certainly wouldn't. So the real question becomes, is 2020 going to be an aberration, or is it an essential business that has been open and that's continuing to operate as normal? And then you just may have some normalization adjustments as being non-recurrent. I mean, we're going to have to consider it from a practical standpoint any way we slice it, because this is going to be a very unusual year for most businesses. What about the business that all of a sudden has a tremendous spike in its business because of the pandemic? Isn't that also an aberration?
Right.
Is somebody really going to pay in anticipation that there's going to be another pandemic in the foreseeable future? And
Well,
I
what you're
think it gets
speaking
back to facts and circumstances.
But what you're saying, if I'm following you, Gary, is speaking about cases where the valuation dates say is at the end of 2020 or 21 when we've got all this behind us, right? I mean, you would be able to potentially consider whether to eliminate the results of 2020 or not. For the unfortunate of us that may have a valuation date now or during the year 2020 when it's still an element of future cash flow, you know, it becomes a lot more problematic in terms of how to deal with it.
Oh, absolutely. It gets back to none of us have a crystal ball, and none of us can forecast what the outcome is going to be of all of this, whether the business that all of a sudden reopens up is ever going to end up reopening up.
Right.
I mean, that's going to be a challenge. I mean, and that's I guess that's why we get paid the big bucks. We should all double our rates, and we have no problems. You know, we can afford to be wrong.
Well, the other thing I want to mention on the PPP, on the loan forgiveness side, I mean, the modeling that we're doing, and even for, you know, I still work with some large tax related clients, and we're modeling out what their loan forgiveness looks like, and we're asking in some of our valuation projects for forecasts of what the loan forgiveness might look like. And it is rare that I'm seeing one where the full amount of the loan is being forgiven. It is, you know, the tests and the hoops that they've put in on the loan forgiveness side. Now, granted, most of it is being forgiven, or the model is saying, but it's been very interesting to see that in many cases, just because of the way the initial loan amount was calculated and now the forgiveness is, that they're different tests, obviously, and the amount left over that will then become a debt. It will become it's just a 1% loan for 2 years. It is not being forgiven. And, you know, I think to Gary's point, in the 2020 year, do we just throw it out? In 2 years, 3 years from now, when we're doing evaluation, say of valuation date of 2023, and we're going back and looking at our 5-year history, you know, we're going to throw out 18 and 19 because that just isn't happening anymore. 20 is probably going to be depending on the company and the individual, and we'll have a couple years to look at and perhaps in post-COVID mode. So, you know, you're going to hear it over and over again in this discussion today, but the company specific factors in the industry are so important to look at in the forecasting, in these loan programs, in all of this. You are just going to miss the mark if you are not really dissecting your specific company.
You know, Michelle, the one thing that I think we also need to make sure that all of the listeners are really paying attention to is going to be the impact on the cash flow. You've got these loan proceeds coming in that aren't going to be paid back. Be careful not to start capitalizing loan proceeds into perpetuity, because you're going to be creating value because a company was able to borrow without paying it back. And that's not really going to create value per se. It may be temporary, but you've got to be real careful with how you treat those funds. And you have to give a lot of thought to it.
Mm-hmm.
One of the comments from the audience came in about potential opportunities for forensic accountants to assist in the auditing of these loans. What do you see in that sense, either auditing from the SBA standpoint or from the recipient standpoint, helping them with that? Do you see anything there in terms of opportunity?
I would say most definitely, because the SBA doesn't have the horsepower to do it. I don't know how much time they're going to spend doing it either, for that matter, but you know, most of the onus is on the banks to review the documentation when it comes to this loan forgiveness, and then the SBA. So they're the first line of defense, and then the SBA will look at it, approve it, and they have so many. I think they have 30 days well, what do they have to approve it, and maybe 6 months to audit. I can't remember the timetable, but definitely they're going to be increasing. I mean, they're going to, like an IRS audit. What's the percent of being audited right now? I mean, 0.1% or something. So I don't think they're going to have the horsepower to do it, but certainly we will be in position to be able to do that and offer those services. And maybe it's more on the bank side. You know, maybe we go to banks and offer services to help them make sure they're looking at the right information and how to maybe set up some procedural type things on the front end when these loan forgiveness things come up.
The only thing I would caution is, at least my experience in working with banks, they usually don't want to pay good hourly rates. So if you're going to take on that kind of work, be serious about the fact that you don't want to be doing this work at discounted prices where you're doing audit, because there's a cost to doing any kind of an audit. And you want to be careful that you're at least able to charge a reasonable amount for the service.
Mm-hmm. The one thing that we are encouraging folks, especially on the FAQ 31, as we all reference it, the certification that you really did have the financial need for the funds, is to contemporaneously right now document what is happening in your businesses and why you need those funds from a cash flow perspective. So, you know, in some instances, it's really might not be the impact right now from cash flow, but it's 3 to 6 months from now. Like, people are living right now off the backlog of whether it was work in process, whether it was accounts receivable, you know, whatever it was. So businesses are really cash flowing based on the backlog, and the real impact might not be for months down the road. And so if someone were to be audited and they come in and say, well, your cash flow was perfectly fine during this 8-week covered period, why did you feel you needed the funds? I think making sure you or if you're advising businesses to document your files and keep track of that, so you can really show the auditor, if you will, what your thought process was at the time.
I was thinking.
I actually saw an article in today's Sun Sentinel this morning. 2 people in Rhode Island were arrested for taking PPP loans where they really didn't have a need for it. And they've already been arrested. They've already been arrested for fraud.
Who arrested them?
I'm not sure. That it didn't say, but they actually gave names, and they talked about people that took about $500,000 of PPP loans that didn't have employees, or the business wasn't fully operating before the pandemic, and they applied for loans, and they've supposedly already been arrested.
Oh dear.
I was thinking, Michelle, I agree with what you said about all of that, that for those of us doing valuations a year from now, 2 years from now, it would be so useful and informative from an analytical perspective to be able to get those contemporaneously prepared analyses of why they needed the loans as a window in terms of trying to project what those future cash flows are going to be. Are your receipts down, or were there canceled contracts? Was there this? Was there this? So from the perspective of documenting your loan, I think what you're saying is critical, but there are even potential valuation implications in terms of getting that information after the fact for these companies we're valuing.
We just got a question before we move on to the next topic. A question from the audience. So would a PPP loan not forgiven be considered below market and have to be adjusted in certain situations?
I don't know that I would consider it, because it's technically, to me, it almost is market, because millions and millions and millions of businesses have gotten it. And it is a legitimized loan that a lot of market participants have taken advantage of. That would be my initial thought.
But the interest rate may actually be below market because they were given at very favorable rates.
Right.
And it's possible, depending on facts and circumstances, that you would have to consider it to be a below market loan, at least based on the amount that you'd have to pay back, considering the interest rate, if you're valuing the liability on the balance sheet. Something to think about.
Yeah.
It's a good question.
Good question. Thank you. Before we get into a bunch of questions coming in about valuation methods and what is it becoming more clear which methods are becoming more preferred? And if yes, which ones are gaining favor or should gain favor? Harold, maybe you'd like to take that.
Yeah, I've said from the get-go, and what I've advocated is using an income approach and financial forecast and incorporating that into a discounted cash flow method. I know there have been criticisms regarding looking forward, that it's difficult to project, et cetera, et cetera. But as Gary alluded to earlier, nobody has a crystal ball. The only way to know an actual value is to have a transaction, which in most cases we don't have. And if you hearken back to IRS Revenue Ruling 5960, the guidance there is that valuation is a prophecy as to the future. Our job is to, use the best information available to us to develop a reasonable estimate of value. And again, at least in my opinion, I think the best way to do that is using an income approach and a discounted cash flow methodology. I think you're precluded from using a capitalization model, based on, for example, some average or weighted average or what have you of historical earnings, because to try and reflect what is happening now and adjust your cash flows to accommodate that is problematic. So I think by default, you're almost forced to use a DCF method. The way that we've implemented that is that we're typically coordinating with management. They are in the best position to know their business. And assuming that you're dealing with knowledgeable management in a typical business, we would have them prepare their best estimates, their best financial forecast, and reflect different scenarios. For example, a best case, a middle of the road case, and perhaps a worst case. And as part of those projections, going back to what we were just talking about in terms of the PPP loans, et cetera, we would reflect the impact on cash flows for the discrete period of any effects that might flow from those. Again, limited to the discrete projection period. Now, when we talk about the terminal period, you're going to have to normalize that to reflect expectations going forward. So I would not propose to do it there. And then the final thing that we would do would be to assign weights to each of those alternative scenarios, again, based in consultation with management as to what they thought the likelihood of achieving one or the other scenarios were, and then use that as a basis for our estimation of value.
Okay, thanks. Anyone else want to chime in on that?
It does create a complication if you're in a jurisdiction where the discounted cash flow isn't permitted. I mean, there are some. So, I've seen instances and probably even done it before where one can try to do a discounted cash flow and then figure out how to frame it so that you arrive at a similar overall conclusion that's on the same par using some kind of capitalization model. But you're right, Harold. I mean, these are interesting times we're in, and it does create complications when you can't do a DCF.
Yeah. Can I?
I think I think the other practical problem, and I agree with you also, Harold, I think the other practical problem is using a market approach is going to be a very difficult task at this point. I mean, the market tanked. Now it sort of has leveled off a bit. And how you're going to get comparability between the subject company and the publicly traded companies, I think it's going to be a real challenge, including how do you factor growth rates into all of that. So, I'm a proponent for DCFs, wherever possible, but I agree, Stacy, a bunch of the people that work in the divorce arena, courts don't necessarily like discounted cash flows.
That's right.
And the fact of the matter is, a lot of times it's because the forecasts are done so poorly.
Yeah.
It may just be more of a challenge now on us to better explain to the trier of fact, assuming that they eventually have trials again. But eventually we're going to have to explain to them why this is the only way that makes sense. Otherwise, they're asking you to put a square peg in a round hole.
I think it will help if both experts are using the DCF, because then at least if two opposing experts come to a divorce court and both have used it, it's going to be hard for the judge to not, and then it's just a function, as we all know, of what are the devils in the details. My only issue on the practicality side on the forecasting is sometimes we do have management that's not so good at forecasting, has never done a forecast before. Amazing, I know. In a perfect world, we'd get this wonderful forecast like Harold is describing on the best case, worst case, most probable. They know their business better than anybody, but I don't have that kind of project base 100% of the time. So it's going to come down to me working with management and helping them come up with this forecast, which is fine. We're all very capable of doing that. On the flip side, if we just get these management numbers, I'm always fearful of, you just used management's numbers and didn't really even test them on your own, or what data did you support management's forecasts with? So it's just management doing their valuation and you're just putting your, black magic cap rates on it. So, or discount rates. So, I mean, there's a lot of open-ended questions and issues in all of that, but there's still a lot of uncertainty in how we're going to go approach even from the DCF. But I do agree, we all should be trying to focus on DCF models. And in litigation, talk to your opposing expert right up front. I mean, that's going to be my hope, is to get on the same page right up front, so we're both using similar methodology, and then we can just argue about the assumptions.
We just got a comment from the audience. California divorce courts do not allow DCF methods for divorce valuations.
Yep.
How best to incorporate all of this into the capitalization earnings method?
Well, you can always back into it.
That's what I was trying to say.
You would still do your DCF on the, in your model, come up with your number, and then you can sort of backdoor it into a CCF model. It can be done.
Just pray you don't have a big growth rate in there. If you have a big growth rate in there, you're in trouble.
And a couple comments. One, following up on Michelle's comment about the management projections, I want to be clear. I am not advocating simply blindly accepting management's projections. Again, they should be in the best position to know their business and their industry. So I do look to them to develop the initial projection, but I think it's incumbent on us as a professional to critique the underlying assumptions and make sure we're comfortable with them. The second thing, going to Stacy's comment about the CAP model, one of the issues you have with courts, setting aside California, where you may be precluded from using it, a lot of judges simply don't understand the difference between the two. A capitalization model is a projection model, okay? It's a single stage projection. You're using historical performance as a basis for doing a single period projection. Or alternatively, you're developing a 1-year projection, whereas a discounted cash flow multiple is simply a multi-stage projection using a discrete period of, say, 5 years and then a terminal period. Again, a lot of the courts do not understand that distinction, and in part, that's attributable to us doing a poor job of explaining it. So that's on us. The final point I had was with respect to Gary's comment about the market approach, and I do agree that it is very difficult to use that approach in the current environment. You know, if you think about how the multiples are developed, there's 2 parts. You have a price multiple in your numerator and an earnings metric in your denominator. And the issue is whether or not the effect of the pandemic is reflected in either. And I think that's your biggest issue right now. If you're trying to rely on current public company multiples, I think there's a problem. If you look into transaction multiples, the issue then becomes is when was the price for that transaction agreed to? You know, is it current? Does it reflect the impact and the expectations of the pandemic and relative expected growth rates or not? So I think the market approach, while we do use it, you know, but we typically use it as a corroborative type of value, I think to place primary reliance on it is an issue.
Okay, thanks. Yeah. We just had another question. Speaking of
Harold, do you think you'll still be using? I have a question for Harold. Are we allowed to ask questions? Do you think you'll still be using the market approach as this corroborating evidence, or, you know, I typically use it as a reasonableness test. Is it in my range? If I have a really good set of comparables, I may use it as a primary method. But do you still think you would use it even as a reasonableness test when we don't even know? I mean, if you're using pre-COVID earning streams and pre-COVID multiples, is it still fair to use it as even a reasonableness test?
No, that's an excellent question. And you hit the nail on the head is whether or not, first of all, you have comparables. All right. So let's assume we have a public company, for example, in the same line of business. The majority of its revenues are, attributable to the same line of business, so on and so forth. So we satisfy all that criteria. I probably would not, again, place reliance on a value using current multiples because I don't think they reflect the impact of the pandemic. I might show them, okay, and show the analysis, but I would probably not place weight on it, at least in the current time frame.
You also have to make sure that you don't get a false positive out of the result, because you may be fooling yourself by thinking, gee, this really supports my income approach, and you don't know enough about what's in those multiples, as Harold said, to really know whether you even have good data or not to compare.
Yeah.
But you are obligated to consider that approach, isn't that correct?
Mm-hmm.
Yeah, I mean,
well, under the standards, we consider it, but we don't have to put weight on it.
Right. Depending on the scope of the assignment, if we're doing a full scope appraisal or evaluation engagement in AICPA terminology, we are required to consider it. As Gary just said, whether or not we rely on it, that's another issue. That's the appraiser's judgment.
Now,
but Harold, you were distinguishing between guideline public companies and transactions, I think, in your answer, right? When you talk,
I was using that as an example in response to Michelle's question. With respect to transactions, those are problematic also. You know, as I said earlier, depending on when the transaction was negotiated, you may have a contract that's being executed now. All the negotiations took place back in December. I hope nobody's doing that, but to the extent they were, you've got to look at the facts and circumstances and make a determination as to whether you believe that transaction price is representative of current market conditions.
Now, we haven't talked about it, but asset approach, liquidation value.
There's going to be a lot of that going on.
I mean, we talked. Right
That's going to go with my prediction of bankruptcies being filed.
Exactly.
We're going to see more and more asset approaches.
I think we're going to see that, and don't immediately discard it like we typically do. Oh, the asset, that's sort of, this is an operating company. Why would that ever be relevant? It's been profitable. So we may start seeing a little more of that, and we may need to make friends with our machinery and equipment appraisers that we haven't been in touch with in 10 years since we had all this in 8 and 9, or real estate appraisers. You may want to send them over lunch or something and let them know you may be needing them in the near future.
Going back to the projections, we got a question from the audience on the DCF method in terms of reflecting the risk. How was this group thinking?
Use a 75% discount rate.
Oh man. Well, this is a good segue into the cost of capital, I think, isn't it? Isn't that what they're
Yes. But anyway, the question was, how do you reflect it through the discount rate while using a single cash flow forecast, using the scenarios purely there, or a combination of both, or is there some framework of thinking of carving out a specific virus risk and building it into your build-up method? So maybe we'll talk to Harold, if you want to continue. How do we reflect that risk in our approaches?
Yeah, I would indicate you have to be careful that you don't double count risk. For example, in doing the scenario analysis that I described, where you're assigning probabilities to each of the alternative financial forecasts, to some extent, you're reflecting some of the risk of achieving those financial forecasts by virtue of the weightings themselves. And then you have the separate issue of the discount rate, which reflects also the risk of achieving those expected future cash flows. When we apply the approach that I just described, where we're using a weighted probability analysis for the forecast, we would probably develop a single weighted average cost of capital and apply that to all three of the forecasts, as opposed to calculating a separate WACC for each forecast. So in that, we're doing that because we do not want to have the double counting, if you will, between the two. Does that address your question?
Yes.
We may also do a sensitivity analysis and do maybe a single forecast, but then alternate the discount rates by using several different levels of discount rate to see what the sensitivity is, in the answers, because depending on how low the forecast is, if you're forecasting lower cash flow, in theory, there's less chance that you're going to be wrong. Because if you're going to be wrong, you're going to be wrong you're going to have too little as opposed to too much. Risk is really something that we're worried about in being wrong. And the question is, if we're going to be incorrect in the cash flows, and you've already forecast low cash flows, you don't want to also have a high discount rate, because then you're really banging them twice.
Right. I'm a big fan of the sensitivity analysis, and we have a sensitivity table that we use in our model that has one axis and the rate discount or cap rate in that case on the other axis. And it's great for the attorneys, especially at mediation, because somewhere on that table is the value. Ours is usually right in the middle, so we can see how it expands one way or another. But we can easily see, okay, well, if we just move a little to their side in negotiation and mediation, where does that put us on the table without having to recalculate all of our numbers and have everything handy? And so I'm a big fan of the sensitivity table analysis personally, and just using it as a tool.
Yeah, we have also done what Gary described, where if we're using a single period projection, we would do alternative analyses of that nature. Andy, I think there's one question I didn't answer that you asked about whether or not we would consider a COVID-19 specific risk premium. And short answer is no. I don't know how you'd quantify it. So
I don't either.
When,
Yeah, I don't think any of us can.
well, isn't it similar to quantifying company-specific risk, where you're looking at a bunch of factors, asking questions? I mean, what if you have done a valuation on 12/31 and you need to update it, and you simply need to consider the impacts of the virus? Wouldn't you be essentially doing that?
I don't think you can do it that way. I would argue I would reflect that in my cash flows. I think you got to.
I agree with Harold on that one.
You'd have to totally redo the valuation.
3. Yeah, 3 times, Harold.
This is a new.
He's going to want to save this one into eternity.
Well, I'm going to bring up just on this, how do you quantify it? Because we've spent a lot of time looking at this. I know we're going to cover cost of capital here specifically. I think Harold's going to kick us off, but in terms of how do you quantify it, I can tell you and share with the group. Again, these are out on the internet. Demoterin has this out on his site now through April 30th, and he's quantifying, if you will, a bit of a COVID factor here. So he's, interestingly, with his COVID, his is computed with updating this index for a drop of 30% in 2020 on earnings and not recovering until 2025. So that's embedded in his COVID ERP. And the difference there, you can see up at the top in his writing there. The standard ERP is the black line. The gray line is the COVID adjusted. So he's taking a position that there is some COVID impact here, and you can see what his assumptions are. Again, use this for however you want in your practices. I'm just sharing that this information is out there. Additionally, we have, again, flipping back to the Duff and Phelps presentation. They analyzed these 11 factors, and I think this has been included in all their historical normalization. But again, looking at their factors, you can go through this on your own. There are pluses and minuses, but I'm going to get to the answer first, and then I'll flip back there. But they have determined that they're increasing their normalization rate up a point. So they're at 9% now. And I think when you look at them historically, this is the historic recommended ERP. So you can see they jumped a point from 8 to 9 ultimately. So they've identified a point, interestingly. And then I did put in here, I thought it was interesting to just look at the difference over the years between if you're using the spot rate and the historical, those same charts and what those have looked like. So, there are some folks out there who are trying to quantify this COVID risk. These are the tools we have out there currently. But again, each individual is going to have to take this data on their own and decide what they want to do with it. That's all I want to share.
For those that do litigation work, think in terms of how are you going to survive a Daubert challenge. If you're purely going to rely on all of these other models that are out there, the first question that a good cross-examining attorney is going to ask you, why is this model correct versus all the other models? And none of them are the same. So how do you support using one versus another? And there lies the problem. We're just relying on other people's opinions. And, if you looked at what Demoterin did, and I have a lot of respect for Professor Demoterin, I think he's brilliant. But when you look at his assumption is a 30% drop in the 2020 earnings and 75% recovery by 2025. Well, what if it's a 25% drop in 2020 and an 80% recovery in 2025 or a 60% recovery? All you're doing is substituting your guess for somebody else's. I'd rather guess myself and be wrong, because I could just see getting killed on the witness stand relying on something like this.
Well, one thing I wanted to point out in that area is the historical ERP incorporates a lot. Now, this chart is only going back to December 07, but remember, this goes back, the ERP that we use goes back to what, 1926? I mean, think about the Depression, the wars, I mean, the bubbles, it's got everything in it. And I can just see a judge going to your litigation questions saying, wow, you mean this historical ERP number incorporates all these things that could possibly happen because they did over the last however many years, 100 years. Boy, that seems to be some good data. You know, why do we want to look at, and I'm just thinking from a judge's simple-mindedness, why do we want to look at these two unknowns when we have all this known history? So, you know, it's out there.
Absolutely.
Use it however you want as professionals, but just know what all these arguments are going to be.
Well, I mean, as I mentioned right at the beginning of this, you also have to worry how every company is going to have a different impact here from all of this. There may be a small number that benefit. There may be some that are going to go out of business. I'm sure there will be. There are others that the effect is going to be delayed, as Michelle said, maybe into the fall. So, and the degree to which is going to vary. So, you know, I would be a little bit concerned about using some kind of standardized approach in particular. And, you know, as you pointed out, Michelle, when you look at the data that's out there, we've got almost 100 years of it now. Really fortunate to have that long-term trend to be able to assess and all the different things that have happened in it.
Remember which data set you're using. If you're using the CRISP data, you're correct, 1926 forward. If you're using the Duff and Phelps data, that's only 63 forward.
Right. That's a really good point.
But you also really have to consider the fact the industry that you're dealing with. You know, I valued a company not that long ago that provided wheelchairs to people that were going on to cruise ships. Well, what do you think has happened to their business lately? Needless to say, I seriously wonder if that business is even still around anymore. But would I want to start using the overall market to develop my discount rate for this kind of a business that's so reliant on the cruise industry? So you've got to go back to your fundamentals and look at the facts and circumstances for the company you're appraising and the industry it's in. The reason that 5960 tells us to consider the industry is that very reason. It's not one size fits all. And it's not a question of slapping in things from my world into the back of a report and say, I've now done my industry analysis. Because 90% of the time, you're going to be wrong if that's all you're doing.
So one argument I've heard on the use of the typical spot free rate and the historical ERP, whichever one you're using, is the risk-free rate is so low. I mean, extremely low. What is it, under 1% right now? And so we all know that if we use a historical ERP in the current spot rate, that combined number is lower than it was December of 19. But we all know that our companies, most companies, probably aren't worth more. So do we bump up the company specific, industry specific, just for the mere fact that the spot rate has dropped so low? Or how are you?
You know, that goes, Michelle, that goes to the very question of when we calculate a discount rate, are we worried about the building blocks that get us there, or are we worried about the total discount rate to reflect the risk? And the fact is, I, for a long time, have taken the position that just because interest rates drop a little bit and your risk-free goes down, doesn't mean that every single closely held business that we appraise is worth a ton more. It just doesn't work like that. And there are things that are constantly going to be offsetting each other in the process. You know, a build-up method, a capital asset pricing model, these are just tools. At the end of the day, the question is, did we get the right discount rate? Not do we have the right spot rate? I mean, you could have the right formula, and you could have all the right components, and you could have the wrong answer. I tell my staff that all the time. They hate me for that. But I've been telling them this for almost 40 years now.
So can we just get rid of the building blocks in our reports and just settle on our discount rate and basically say, this is our discount rate, and you'll have to dig into the details later?
Well, you know what? Frequently we do. Frequently what we do is we talk about alternative investments and what their cost of equity is. And we basically come up with a discount rate without showing all of the minutia. If I'm valuing a medical practice, what good is starting to build up from the public market when there are no publicly traded medical practices? I mean, how do I accomplish my goal without having to somewhere along the way making up a specific company risk premium? Or all of a sudden what we've been doing more often than not, instead of just putting in a specific company risk, we're saying, look, here are the alternative rates. In our opinion, this company is 150% more risky based on the rest of our financial analysis about the company, and therefore we bump it up by a factor of 1.5. We're getting away from the traditional buildup because in these times, it doesn't work. After the 2008 recession, all we kept reading about was the flight to quality. The interest rates can't be right. They're too low. Well, here we are with 12 years later. We're still talking about them being too low. Isn't that the market? After 12 years, isn't this a reflection of the marketplace?
Right.
So what are we doing? What are we doing as appraisers?
So look at the one with the spot free rate on it. Yeah. I was just going back to see it was down in the.
Yeah, I mean, take a look at that chart.
I know.
So
It's been a very long flight to quality. My wings are tired from flapping and trying to fly all this time.
One thing I noted on this Duff and Phelps chart, it just caught my eye. Of course, they just bumped theirs up to from 8 to 9% for the combined normalized amount. And I was looking back historically, and so they started the 9% back in December of 13, and it was 9% from 13 to December of 15. And I'm just thinking, you know, generally speaking, are we today, as we sit here today, in the same spot that we were August of 13 through 15? I just feel like we're different times. So I don't know. There's so many.
I think we're in different times too.
So
I agree with you. We're in different times.
So in terms of this reasonable, so stepping back at the end of the day, what are you using as some kind of a continuum or reasonableness check? I remember, Harold, in a couple of presentations you've made on cost of capital, you've shown this, and I've seen it in several places, this kind of chart of, okay, here's the risk-free rate from one end of the spectrum, and at the other end is an early stage venture capital investment, which is like a 50% expected return. Are you talking about something like that? And okay, where am I setting now into this continuum?
Yeah, we use that. It's sort of somewhat similar to what Gary said, but you know, for example, you have empirical data to quantify all of the building blocks in either the build-up or CAPM model except for the company-specific risk premium. That, as we all know, is based on professional judgment. So the question becomes is, how do you determine if a cost of equity that you've calculated using either of those two models is reasonable or not? And one way to do that is to compare your total cost of equity that you've calculated using those models with total rates of return in the market. So for example, if you look at either the CRISP data or Duff and Phelps data, you can look at the average rates of return for either the 10th decile in CRISP, if you're doing a fairly small company, or alternatively the 25th portfolio in the Duff and Phelps data, as essentially a floor that your cost of equity should not go below. Again, all else being equal, there are exceptions. And then at the other end of the equation, if you want a ceiling, if you will, I would look at rates of return that venture capital firms are paying. So you basically have a range, if you will, again, depending on what year you're looking at, I'll say the high teens to maybe the high 20s. And the rate of return that you're developing for your closely held business should fall somewhere in that range. Again, if you're looking at total cost of equity as a basis of comparison. That's the approach that we've used consistently. I wish I could take credit for having developed it, but I have to give credit to Jim Hitchner, who initially turned me on to that. And we've used it religiously and successfully, particularly in litigations. It's a really good benchmark.
It's a powerful visual too. When you
I actually call it the rate of return department store in my book. I actually have a visual of it because every building block, and it's something in all candor I learned in taking classes at ASA. I'm not going to take total credit for it. I mean, I've had instructors show me that concept, and it really helps you understand the cost of capital. All we're trying to do is figure out where in this scheme of things is the subject company fit that's cash flows. And you should be able to look at under the principle of substitution. You should be able to see what alternatives are in the marketplace at the valuation date and where should your subject company be. It's not just a question of building up. It's really looking at alternative investments. And that's why I keep saying we go back to basics.
In our back to basics analysis, I'm trying to segue back to my point I want to make. The company specific in these COVID times, I think is going to be where we're going to need to support whatever discount rate we come up with that's reasonable to us. And I do want to give a shout out to Ron Senior. I think most everybody probably on this know Ron, and he's a friend of the community, the BV community, but he's developed, and I understand Business Valuation Update will be publishing in their next issue what he's developed, which he's put a lot of thought and time into a COVID-19 risk factor tool. And it goes through a bunch of questions to ask your companies or to make sure you're considering regarding your company. And part of it is the industry. Part of it is also physical operations, whether you're a service industry or a product type industry. And so watch for that. I think it is just a fabulous tool and very well thought out. And I'm sure there are many other questions folks will come up with in the meantime, but I think it's going to be a great starter tool we all can use as considerations we should be giving and documenting our files and how we're coming up with how this specific company has been impacted by the pandemic. So watch for that. And thank you, Ron, for putting it together.
The one thing that we all have to be careful of, especially those of us that do a lot of litigation work, the one thing we know in a discount rate, the one portion of a discount rate that every judge I've ever appeared in front of hates is specific company risk. I've heard it considered to be nebulous. I've considered it to be witchcraft. I've heard it be hocus pocus. I mean, I've heard judges use every word under the sky to describe this stuff that you can't get your arms around. So what you want to be very careful of is not putting so much stuff into specific company risk where it ends up being a huge line item. In some cases, you're better off looking at alternative investments and coming up with a comparison, because now you're exercising judgment. You're not showing a 10% specific company risk premium, because I see a lot of those in reports. And if you think about it, that in some cases that doubles the public market. Now, I'm not saying that it's wrong, but when the numbers are so low, is the risk really so high? And we get back to doing the job properly. And, a COVID-19 specific company risk premium, I have enough trouble getting a discount rate without putting one more factor into it. You still have to think about it.
You just opened up the door on that one.
Be nice, Harold.
I think what also this framework that Michelle was talking about from Ron, we'll be having it in our June issue, comes out in a couple of weeks or late next week, is kind of just a framework of thinking of how to account for it in your valuation, whether you treat it as a separate premium or as in your cash flows. So I think it's very helpful in that regard. And it has some very specific questions on the impact of the subject company's business from the virus. So it'll be helpful in that regard, just as a framework of thinking. It's not a model.
Right.
You don't want to use the word model or recipe.
It's a tool. It's a tool, a framework. You made a really good point there. It was subtle, Andy, but some of these things are going to be handled in the cash flow and not the discount rate.
Right.
And just going back again, you really have to be careful not to double dip.
Yes. Exactly.
Because if you're going to do that, why not put it in the discount for lack of marketability? The businesses these days, because of the COVID, are also less marketable. So why not put a COVID-19 discount for lack of marketability into the equation? I mean, we can go crazy if that's what we want to do. Right.
In the interest of time, we're kind of we're at the end of our allotted time. We'll go a few minutes over time. There was a bunch of questions coming in about discount. Speaking of discount for lack of marketability, and just kind of a composite of these questions is. Should the discount be increased? How do you support your estimate of the increase? Is there any data you can look to? I think we've touched on some of this, but we could speak to the discount per se. Stacy, I think you had a thought on that.
Yeah, I mean, whether we're dealing with a COVID-19 environment or something last year, the year before, I mean, I've often looked to the Mandelbaum factors as a way to get grounded in terms of what I'm dealing with, whether I'm valuing an entire company or and then an interest in that company. And so I analyze the metrics for the company as a whole, and then look at the specifics for the interest that I'm valuing. And some of it's quantitative, the profitability, distribution history. Some of it's qualitative, looking at terms and the ability to sell, recent transactions, things like that. And there's a lot of things in the Mandelbaum decision. When we were talking prior to this webinar, Michelle was also reminding me about the IRS job aid on discounts for lack of marketability, which has been around a long time at this point, but it's got a lot of text, a lot of meat. It goes through all these different studies. It talks about Mandelbaum, and it talks about the advantages and disadvantages of all these different things out there. So, I mean, I think that's certainly worth looking at, thinking about. I mean, the thing that I think I said the last time we had our discussion last month is I would just be careful. We're talking about not double counting these effects, but also if you're in a business that's still generating positive cash flow, you might not be able to sell it right now, but you're still getting the effects of that benefit stream. So I would think that would also have the potential to mitigate the discount that you're dealing with. But like everything, I mean, it's being able to get that data and analyze it and try to figure out the effects and the relative strength of not only the company, but the interest that you're valuing.
Any other comments on the marketability discount?
I would just say I don't think we've really changed our line of thinking on marketability discounts right now in this environment. Whether there's mitigating factors like you mentioned, Stacy, we're still, we use the studies certainly, but we do hone in much more on the Mendelbaum and the qualitative factors as best we can in our subject company and our subjects, where the real meat of the DLOM can come into play, and try and correlating it back to how your company and your interest is different than those studies is key. And I don't think we've changed our line of thinking or approach on that.
Okay, thanks. Well, we're kind of in overtime here, so we're going to have to wrap this up. Again, there's a lot of questions in the queue that we're not able to get to. We'll capture those and address those later. Could I ask for some, a couple of wrap-up comments or final thoughts from our panel? Stacy, we'll start with you, please.
The last time we had our webinar, I remember making the point that there was a lot that was instructive from the last recession. And while there are differences from then and now, such a drop off now versus then, there's a lot of different things. But I still think there's plenty that we can look at and think about that we dealt with the last time we went through this. That said, the more I think about the environment that we're in right now, I really think that a customized approach is important, because the short-term versus long-term effect, the industry, the effect of debt, everything we've talked about, I think we're going to have a lot of different outcomes for different companies. A lot of that's evolving over time, but I would just really worry about some kind of cookie cutter approach to deal with these things, because I think the story of many of the companies we value is going to be different from one to another.
Great. Thanks, Stacy. Michelle, how about you?
I would reiterate what I said last month, probably, in that it's important to stay current. Talk to your fellow valuation friends. Continue to participate in programs like this or other programs that are being offered. Reach out to your fellow valuation professionals when you are not sure of something. I mean, we need to come together, I think, as a valuation community here. There are no standards. We're in uncharted waters, and the more we can bounce ideas off each other and concepts and try to sort this out, I think the better. So I'll just, put my pitch in again to, the more we can come together and keep learning from each other on this and using even each other's ideas. It's not going to be, I'm not going to be on the stand and be able to say, well, I took this approach because Harold and Gary said so on a webinar and they agreed on it.
It sounds good to me, Harold.
Me too.
We definitely need to support our, just like we said last month, we haven't said it on this one, but back to basics. Keep those fundamentals intact make sure you have thought through, and the customization of your specific interest in company are absolutely key right now.
Thanks, Michelle. Harold, final thoughts for today?
Just two, really. I'm have been an advocate of the income approach and the DCF method, as we talked about earlier, and modeling out cash flows. The one thing that I would suggest that I think people need to be or keep a close eye on is that for this particular recessionary period, a lot of the analysts have been calling for a wave, if you will, that this recession is going to look more like a W, where you had a sharp drop, a rebound, and they're expecting another drop and then a later rebound. So it's going to be like a wave, if you will. And I think a lot of people are overlooking that in light of, what is the recent rebound of the market going back up, and thinking that we're going to have a return to normalcy right away because certain states are opening up, certain businesses are opening, et cetera, et cetera. And I would just caution people to be concerned about whether or not that truly is a short-term effect or not, because I think the worst is yet to come. Not to be a pessimist, but I think that is what the future holds for us, and we need to be cognizant of that. The final thought I'd leave people with is that it's certainly been nice to have a group like this to participate in the webinar with and share thoughts, as well as other professionals around the country that I've had the good fortune of knowing and conversing with in these recent times. There's a lot to be said for having a network of knowledgeable contacts that you can reach out to see what they're experiencing. I might even include Gary in that group. So I'll leave you with that.
Well, Gary gets the last word here. So, Gary, final thoughts for today?
Harold has left me speechless. No, I mean, look, just as I said the last time, I think that this is another instance where common sense has to prevail. We have to look at the facts and circumstances of each valuation based on the type of business, the geographic location. I mean, we have to consider everything. For those that do litigation work, don't allow yourself to be put into an advocacy position where, it's doom or gloom or everything's going to come back rosy depending on which side of the litigation you're on. The fact is, this is a time that you really have to do your job. And doing your job is going to prove whether or not you understand anything about the subject company. It's all about fundamentals. And as long as you go back to fundamentals, you'll be okay in this business. Just remember, it's not business as normal. If you love the excess earnings method, if you love a capitalization model, don't love it anymore. Times are different. You need to go back to the basics. And, I do agree with Harold. You have to use a discounted cash flow 4 times. Absolutely. So, on that note, I think, I'll mimic the thoughts that we're not an island. You got a lot of people you could reach out to if you have questions. And most of us are happy to answer questions for people. So, when you start feeling like, oh my God, what do I do? There's always somebody out there you can reach out to that'll help you think through the problem. And very often we've all been in that boat once before. So by all means, take advantage.
Well, thank you, Gary, and thank all of you for reaching out today to our audience. Very, very helpful. And I want to thank our audience for attending